Dan Celia.
Our poverty level has done nothing but go up.
I really, really appreciate your show and everything that you're doing. May God bless you.
Your personal economy.
You can't say, I don't want any risk. I don't want to take any risk. I just want to put my money in a CD and forget about it. But I want to earn 18% a year. It doesn't work that way.
Conservative talk radio you can count on.
Once again, Steve Forbes. Hey, Steve, how are you?
Dan, good to be with you.
Financial Issues with Dan Celia.
Hi, Dan. I just want you to know how much I really appreciate the passion that you have.
Aligning reality with truth.
And I've got Congresswoman Bachmann with us right now.
So I just want to thank you. I want to thank your listeners.
We need to save America and keep it intact for our children and grandchildren.
Now, here's your host, Dan Celia.
Welcome back, Financial Issues. I'm Dan Celia. It's great to be here. Well, there's not a lot of economic news to recap. We are going to get to the phones, 866-300-9298. It's what we do on Fridays. We try to get to as many calls as we can. So 866-300-9298. We've had a full board all morning, but we have two lines open. So cue your call up. Just to recap a little bit of what's going on, I talked earlier in the first segment, I talked about the GDP numbers again. I won't rehash that. I would recommend that everybody go back and listen to the podcast of the first hour yesterday, because I think it's important that you hear it. It's an educational piece, okay? So I think you need to go and listen to the first segment. Now, you can get the podcast at afr.net, afr.net. If you can't get it there, it's not there, or you can't find it or whatever, you can go to iTunes. Just go to iTunes and search Financial Issues, and you'll see yesterday's program. And it doesn't cost anything. You just download the podcast from there. Just listen to the first segment, the first 20 minutes, and then you can, delete it. But I think it's worth listening to, because I go through a little bit of what these GDP numbers that came out yesterday really mean, and why we've got to be so cautious before we start getting excited about how good things really are. So make sure you check that out and listen to that podcast. So we got a little bit of some economic numbers out this morning talking about spending and some other things in the economy. But basically, it was just that spending, we saw the spending rate came out, and spending was up 0.3%. The problem with that spending rate is the same problem with the GDP, that the majority of that spending is due to healthcare costs. Big announcement just coming out, I don't know, half hour or so ago, or this morning, that President Obama, the administration, announced that they got 6 million people. 6 million people signed up for Obamacare. That means you got 6 million people that put Obamacare in their shopping cart. It doesn't mean they paid for anything. They haven't gone through the cashier yet. So did they really buy it is the question. No, of course not. But nevertheless, that's beside the point. 6 million people. There are still far more people that have lost their health insurance because of Obamacare. I thought we were trying to get the uninsured insured. Well, the 35 million uninsured that they talked about, well, you can add a whole bunch more to that. So we actually have more people still unemployed than we did before this all took place. Something wrong with that picture? Yes. Not going there. I'm just throwing it out there. Another problem. But spending rate is due primarily to healthcare increasing. So there's more money out of our pockets spending. But it's a consumer spending, so it looks good from a consumer side. There's nothing good about it. So we see that going on. Income was up 0.3%, same as our spending rate. But for some reason, the savings rate went up, and it shouldn't have, but the savings rate went up to 4.3%. And listen, anything over 4% in a savings rate, I'm happy with. I'd like to see it closer to 5%, but 4.3%. I mean, we went a decade, below 2% in our savings rate. So that's some good news. But that's primarily the economic data that was released today. By the way, oil back up over 101. We are starting to see things heat up in the Ukraine. Russia has added 70,000 more troops on the border to the 30,000 they already had. Let me think. You think there might be another invasion? I'm just a wild guess. But anyway, nobody seems to care or be concerned. That's, but it will be an issue. But nobody's concerned because all of Wall Street and a lot of other people don't believe that it's a concern because they don't believe that the European nations or the American government is really going to impose any real sanctions to stop Putin. Even though we could stop him in his tracks. But we're not going to do it because he knows, he's a lot smarter than our president. He knows that we can't do it. Because do we care more about human rights? Do we care more about democracy around the world? Or do we care about the almighty dollar? It's the almighty dollar will win out every time. And we're not going to collapse our financial markets over this. We're just not. And Putin knows that. So anyway. All right, we're going to get to calls. We're staying with calls, 866-300-9298. Let me go to Michael. Michael's calling us from Alabama. Hey, Michael.
Good morning, Dan. How are you?
I'm okay.
Wish I could see you this coming Monday, but I'm unfortunately going to be out of town. I'm in Mobile, so.
Oh, are you? Okay. Yeah,
I would like to meet you, but.
That'd be great. We're the week from Monday. Yep.
I had sent you an email about a week ago, and I'd asked you about my 401k. I've got a 401k from a former employer. Mm-hmm. It's about $3,300, and I was asking about, do I roll it into the 401k I'm at now, which they don't contribute, or put it into an IRA? And you'd said put it into a bank IRA and keep it in the money market. And I just would like you to, I'm not financial savvy at all.
Sure.
And just kind of explain to me what a bank IRA is and how to go about doing that, and also money market.
Okay. Let me ask you something, Michael. How old are you, first off?
I'm 43.
And do you contribute to your current 401k?
Yes, sir, I do. I've been at this company for maybe 5 months and just started contributing just as soon as I signed up.
Listen, I probably didn't know all the circumstances, but I don't have a problem with you putting it in your current IRA at that age. So your current 401k, because I know they're not matching. But if you're contributing every month and you put that money in your current 401k, so there's the law of compounding in economics, and when there's a great benefit to any gains compounding on the gains from the past. So this year, or last year you made money. If you make money this year, it's compounding on all that you made last year plus your principal from last year and so on and so forth. And the principle of it is that there's power in it. It grows. So not to go into all the detail of it, just to say that if you add that money to your current 401k, whatever you do in that current 401k is now compounding on a bigger number, on a greater number. Even if it's only $3,000 you're adding to it, which is great, it's increasing the size. And because you're so young and you're going to continue to contribute for a lot of years, you would probably benefit in the long run more by doing that. So I'm going to tell you that it would probably be better for you so you in your 401k, you have certain allocations. You've got X amount of percentage of your pay going into maybe one mutual fund, or maybe you have a life cycle fund, a 20-40 fund or something. But you've got an X amount of percentage going to certain things. So I would just, when you put it in, just allocate it the same way that you have your contribution going in. And just forget about it and don't worry about it. Just continue to make your contributions under all conditions. And I think you'll be great. I think that's the way to do it.
Okay. Thank you very much, sir, and I appreciate your show.
Thank you, Michael. I appreciate that. Let me go to Jesse. Jesse calling us from Texas. Hey, Jesse.
Hey, how's it going?
Okay.
I just had a quick question for you. I'm 29 years old. I just started working part-time as a youth pastor. I also work part-time as a substitute teacher, and on top of that, I'm a seminary student. Basically, my question is, I have a 401k from a previous employer that I'm thinking of either trying to roll over to a Timothy plan or going with an IRA with Guidestone. I was wondering if you might be able to give me a little bit of insight whether or not one might be better choice than the other.
Well, so Guidestone is offered through your denomination, and are you contributing to your Guidestone IRA?
I don't have one set up yet.
Okay. I would do it through Timothy for several reasons. One, it's going to give you a much greater level of control over it. What I mean by that is you'll be able to move it and change it over time or add to it or take away from it or whatever you need to do. And I like the control. Secondly, Guidestone made an announcement last year at their convention that they can't guarantee they're biblically responsible. I happen to know for a fact they're not biblically responsible. So I think it's appalling, but that's beside the point, and I'm not going to get into the detail of that. But they say that you can't do it. Well, they haven't called me. If they want to, I'm glad to walk them through how you do that. Apparently, they haven't been able to figure that out, but it's very frustrating to me. So I would go to Timothy for both those reasons. One is you're going to have more control, and the other is you're going to be biblically responsible. So I think it would make more sense. And so if you went into, I'll call their strategic growth fund, for lack of better, similar to about a 2020 fund in most organizations. And if you went into strategic growth, that's just one fund, and you just contribute to that on a regular basis, I think you'll do great.
All right, excellent. That clears things up for me.
Okay, thank you, Jesse. I sure appreciate the call. Let me go to Janice. Janice calling us from Michigan. Hey, Janice.
Oh, yes, thank you so much for your program and all what you do.
Sure.
I have a question about rent. I own my home right now in Michigan, and I don't owe a lot of money on my mortgage, but my daughter is moving to North Dakota where there is a school that she's going to for her graduate program. So I am going to sell my house here in Michigan, and she's in Boston right now finishing up on another graduate degree. She's going to put the two together. But my question is, then we'll rent when we go there. What does the scenario look like for renting when times get worse or things really fall apart?
Yeah.
I'm just wondering what that looks like, because we would not want to buy another house right away, not knowing if after she graduates from her graduate degree in 2.5 years, if she would be moving someplace else.
Sure. Well, that's a great question, Janice. So here's what it looks like. So the theory by some, and there's some truth to this, because this, in fact, happened somewhat in 2008. So the theory is that in bad times, more people are renting because they're getting, maybe they've lost their home and they're forced to rent. Maybe they were thinking about buying a home, now they can't. So they're going to be in a prolonged period of time where they're going to be renting. And the theory says that the rental market in general should be pretty good because of that, because there's going to be a somewhat of a shortage of rental properties with a glut of people looking to rent. Now, there's some truth to that. So that's one side of it. The only thing that I would say, because I like to look at both sides of the issue, is that we have to remember if things get really bad, Janice, people aren't going to have jobs. And if they don't have jobs, they're not going to be able to pay their rent. So as much as the one theory that I've laid out there is probably pretty accurate, there also has to be a robust job growth area in the area in which you're renting in that particular area of the country, so that people have jobs so that they can afford to pay rent. So that's the problem. So that's what it looks like. I think that if we have a recession that looks like 2008, I think you'll be okay. You know better of what your area was like there in Michigan, but I think you'll be okay. If we have a recession, which I think is going to be worse, a whole lot worse than that, bordering on a depression or worse than a depression, then you're going to be in trouble. So I don't know if that helps you, Janice. I hope so. We'll be right back. Get to the phones after this.
You get the soil ready. You put the seeds in and then you water it.
How do you plant a garden?
I don't know. You pray that God will give you a good harvest. Then you have to work it to get all the weeds away. And then God brings the plants.
Planting a garden takes planning, hard work, and God's blessing. So does creating a lasting legacy for the people and charities that mean the most to you. The AFA Foundation is here to help you sow the financial seeds God has blessed you with in order for them to blossom for generations to come. We do this by offering free consultation and assistance in the areas of charitable gift annuities, estate planning, will and trust planning, and bequests. To learn more, call 800-326-4543, extension 345. 800-326-4543, extension 345, or visit afafoundation.net.
The opening statement in the Constitution of the United States says this, that we, the people of the United States, in order to form a more perfect union, establish justice, ensure domestic tranquility, provide for the common defense, promote the general welfare, and secure the blessings of liberty. I don't know what part of that we don't get anymore. That was written by men who cared about this country deeply.
Financial Issues with Dan Celia.
Welcome back. Financial Issues, 866-300-9298. We have one line open, 866-300-9298. We're going to get right back to the phones. Let me go to Jerry. Jerry calling us from Virginia. Hey, Jerry.
Hey, Dan.
How are
Good
you?
to talk to you.
Thank you.
I listen to you every chance I get. I wanted to ask you what you think about PIMCO funds.
Mm-hmm.
And do you know if they are biblically responsible?
It depends. They have a number of different funds.
Yes, they do.
Yeah. So if you're in the PIMCO Total Return Fund.
Yes, I think that's one of them.
Yeah, well, that probably is okay. As a matter of fact, it's one of the few mutual funds on my list. Not on my buy list, but on my list.
Right.
Anything else, no.
I see. Well, I don't understand much about finances and all that.
Sure.
I am trying to learn by listening to you. But we lost about $6,000 from PIMCO, from the different funds this past year. Mm-hmm. And I wondered, the stock market, most of the time since the fall, you've talked about how unusual it is that it's up so high.
Yes.
And all this stuff, and it's, I just don't understand. Our American funds, we gained, I don't know, quite a good amount.
Well,
but,
here's why. I can tell you why, Jerry. The reason why you didn't do well, it's not the family of funds. It's not, a PIMCO versus other families. The reason why is because your PIMCO funds are mostly bonds. So if you remember back in April of last year, if you were listening then, I was telling people, get out of all your bond mutual funds now. And I was telling people, sell out of them right now. As a matter of fact, I got some contributions to the ministry from people who had gotten out and thanked me months later because of what they would have lost. So the PIMCO is bond funds, which got hurt last year. They got hurt dramatically last year, where your American funds are mostly stock funds. And we know that stocks in the market did very well. So that's the difference. PIMCO, if I just look at one PIMCO bond fund, their total return fund, it lost like 2.5% last year. So it was down about 2.5%. And where if you look at a stock fund like Timothy Value Fund, it was up over 30%, 31 or 32% last year. So it's a difference between stocks and bonds is why. So I expect that PIMCO is doing their best right now to try to adjust some things, but I am still been of the opinion that it's not it's a better time to get into bond funds right now because I think that they're near a bottom, but it's not quite there yet. And if we see interest rates come up, that's going to hurt the bond funds again. So I think there's some potential for some more pain in the bond funds, but that's the difference. That's why you did good in one and you didn't do good in the other. Two totally different segments of the market. One bonds, one stock.
I've heard you recommend that people that you put like maybe 40 to 50% into a money market account.
Yes.
Or where we'll be safe.
Yes.
And I've considered doing that. We have an appointment with our financial man on Monday, and I just wondered if I should really set my mind to doing that.
Well, here's what's going.
I'm 74, and my husband is 78.
And what is this money for?
Well,
what's it going to be?
Part of it is it's about $100,000 in IRAs, well, his and mine. A traditional IRA, and I have heard you say too that you should start taking that out.
Yes. And so, is this money though? When you look at all of it together, is it money that you use to draw upon on occasion to help supplement your income?
Well, we have to take.
You're right. You have to take your minimum
the
distribution.
IRA.
Yes.
So, but we haven't bothered anything else at this point.
So
we may have to.
Yes.
With the economy the way and the things the way they are, the inflation the way it is.
Right.
But we haven't had to do it yet. Well,
Jerry, I would like to see you do that 40% in a money market account. Now, I'm just going to warn you that your financial person is going to talk you out of that. And what they may suggest is that you go into another bond fund or a short-term bond fund. Now, short-term bond fund is better than the PIMCO Total Return Fund, but nonetheless, those bond funds are going to suffer when interest rates go up. So if you believe, like I believe, that we are going to see inflation in the next couple of years, we're seeing it now, but I mean, see it in more dramatic fashion. On top of the Fed already saying they're going to raise interest rates through next year, then that is going to hurt those bond funds again. So you're going to be going in and you're going to be subject to some more downside movement. So the thing that we all struggle with from time to time is that if I go in a money market account, I am unfortunately earning nothing, and it's very frustrating because I might be missing out on what could be happening. But you do that so that you can miss out on the downturn, because I believe, as you've heard me say, I'm sure, Jerry, that there's real value in not losing. So let's just say you may, as you say, someday need to draw money out of this to supplement your living expenses. What you don't want to do is be in a place that you have to draw money out of your account that is coming from something that is down because the market's gone down, inflation's gone up, and now you've got to draw some money. You have to sell something, or your financial advisor has to sell something out of some mutual funds to get cash so you can withdraw it. And that's a really bad scenario because it hurts the recovery of those funds. You want to have cash, significant cash, that in a scenario like that, you draw from the cash so that you can allow some adequate recovery of those other things that are down. And it's very important. Not to mention, I think that at your place in life right now, that it just makes good, prudent, wise sense to preserve some of what you work so hard to save and how the Lord has provided so much, and you want to preserve. You want to preserve your principal. You can't afford to take losses on your whole account again, because it's going to take 6 or 7 years, maybe 5 years, even 3 or 4 years to recover back, not recover to a profit, but recover back to where it was. In the meantime, the money that you've had in that money market account during that 3-4 years, you've actually done better, because at least you're not getting much, but at least you're getting, 0.25%. And as inflation comes up, that percentage is going to increase as well. So I think that you really need to be sold out and strong in saying you want 40% of this in something that is never going to change, that your principle is going to be preserved. But they will try to talk you out.
I certainly agree with you. I am a partner, and I appreciate so much what you do, and I just hope you feel better. God bless you.
Thank you, Jerry.
And thank you for, when are you coming to Richmond?
We're coming to Richmond. We are coming to Richmond again in the fall.
Oh, good.
We're coming in the fall, so
Good.
make sure you
I didn't
come
get
out.
to come last time, but I'm going to try my best this time.
Good. I hope to see
Thank you so much, and God bless you for what you do.
Thank you, Jerry. I appreciate that. Let me go to Bob in Ohio. Hey, Bob.
Hey. Hi, Dan. How you doing today?
Okay.
Hey, first-time caller, long-time listener. I try to spread the word every chance I get.
Great. Thank you for that.
Yeah, question I have. Current 401k plan with my company, they match up to 4%, which is what I'm currently doing as well. I currently have 75% of my investments in Alliance Bernstein 2035 and 25% in Columbia Small Cap Value Fund. Here within the next week, they're going to transfer all my Alliance Bernstein automatically to the new Vanguard 2035.
Okay.
And from listening to you throughout the weeks and a lot of other different sources, when the market does tank here coming up, I kind of wondered if this would be a good time to reevaluate where I'm at. Should I put all that money into Vanguard 2035, which I don't know a whole lot about? The previous caller talked about PIMCO Total Return Fund, which I do have access to. Should I dump all my money and go all conservative that direction? So that's kind of where I'm stuck at.
How many more years you have to work, Bob?
43. Well, hopefully 5, but
okay.
It'll probably be at least 20, 25 years.
I would go. I would probably, if you want to be a little conservative, which makes sense, I would roll it into the Vanguard 2020 fund for the time being.
All right.
And I would get out of that Columbia fund.
All right.
I don't. I would do anything. I would get out of that. I would probably put that in there as well. So, and then I would say to you, if we have this pullback and we start to see things really bottom out, then I would probably shift and now go into the 2030 or 2035.
Okay. So should I take what's all out of my small cap and also move it into the 2020?
Yes.
Okay. So
I would.
just put all 100% in there.
Yep.
And then eventually move that to 2030.
Yes. Yeah. I mean, the goal would be that in the near future that you can get that moved to the 2030 or 35.
Okay.
All right.
Hey, thank you very much. God bless you.
Thank you, Bob. I appreciate it. Folks, just speaking of those life cycle funds, 2030, 2020, and all those things that so many of you have access to in your 401k. The idea of those, and they work best. So the idea is that everything that you have, you put into that, because those funds, the 2030 fund includes all of those other individual funds that you might have access to. So it doesn't make sense for you to say, well, I'm going to have a little bit in this mutual fund, a little bit of this mutual fund, and a little bit in the 2030. 2030 is not a mutual fund. It is a fund of funds. It is a fund of mutual funds. So, the idea is that it's to make something that is easy, like mutual funds, even easier. So you don't even have to think about what mutual funds. You just look at a time horizon. I'm going to be retiring in such and such a time. And the way you get more conservative or more aggressive is you go into a 2010 instead of, well, not a 2010, but, a 2015 or, a 2020 as opposed to a 2035. So or you get more aggressive by getting out of the 2015 that you're in and going to the 2035. So that's how that works. So just to put a little clarification to it. 866-300-9298. Let me go to JR. JR is calling us from Indiana. We have a line open, folks, 866-300-9298. Hey, JR.
Good morning, and I appreciate your biblical counsel.
Thank you.
I have two unrelated questions. First, my father, who recently had a stroke, has purchased a couple of life settlements from about 4 years ago, and he didn't ask anybody's counsel really, and he just got some, and trying to provide something for his family. I think it was just a wrong. He got shysted, or however you call it, and just wanted your perspective on it.
Well, are there? Do you know if there are time constraints on it, or can he get out from under it?
No, he can't get out from under it. He's paid $15,000 to get into it. He gets 1.724% of the acquisition cost. I guess it's $870 out of a $1.5 million. Then they have a 4-year projected, like a 3 or 4 year projected life expectancy. But this one particular situation has outlived that, and after that period of time, then he has to pay for the premium every year on that, until the person dies, or in this situation, after 6.25 years or so, he would pay the amount that he would be entitled to.
So, are there surrender charges?
As I understand it, if you want to get out of it, you just get out of it, and you lose all you put into it.
Okay. Well, it's one of those deals, and they're not all like that. Some of them have stipulations to get out. We actually have to pay in again to get out. So, you have to pay in a couple thousand in order to get out your $50,000 or whatever it is. Some are truly for life. There's nothing you can do about it. I mean, you got to ride it out and hope for the best and see that there is some turnaround. There's always a possibility, if they're legitimate life settlement programs, there's always a possibility that some of the people in the pool will, not live too far beyond their life expectancy. When that happens, you get a little bump in your interest rate and things could get better. But it's a very difficult situation, and it's almost it's better to stay in and ride it out than and get a little bit of income than turn away all of it. So hopefully that helps a little bit. Thank you, JR. Financial Issues, one line open. We'll be right back. Hi, this is Dan Celia. I sure would appreciate it if you would consider partnering with me in the Ministry of Financial Issues. You'll have access to my stock picks that come out every Monday, along with my commentary. You'll get access to our conference call that I do with our partners once a month, our alert system that I send out as often as necessary to tell you when to sell a stock, maybe give you some comfort during a volatile time, or maybe when to buy a particular stock. You'll get access to the asset allocation model so you'll know how to manage the portfolio right for you, and much, much more. We sure would appreciate it if in your stewardship you would partner with Financial Issues. Go to financialissues.org, financialissues.org. Partner with us and support this ministry. It sure would be a blessing. Go to financialissues.org, financialissues.org to support the ministry.
The opinions and recommendations expressed by Dan are his own and do not necessarily represent the opinions of this station or any of the show's sponsors.
Welcome back. Financial Issues, American Family Radio Network. I'm Dan Celia, 866-300-9298. And we're going to get right to the phones as we go into our last segment. Let me go to Edward. Edward's calling us from North Carolina. Hey, Edward.
Hey, Dan. How are you doing?
Hanging in there, brother.
Here, I'm on survival mode, hopefully. I'm going to just say right quick what I did. I got $97,000 in market fund with Pacific Life, $21,000 Wells Fargo, and $12,000 in the bank market, plus $20,000 in checking account, and $2,000 on hand. I'll be 80 in September. You think I made a good move there?
What was that first 97 in?
Money market with Pacific Life, and the reason I didn't move there is a $4,000 transfer charge.
Yeah. So, I mean, I think you're in great shape. I mean, I think you're in you're fine. I wouldn't do anything different. I would say this to you though: when you're out of this, it's really a surrender charge, regardless of what they call it. When you're out of that, when you can get out of that Pacific Life, I would probably get out of that when you get a chance to. The other thing is, it wouldn't be well, no, you're okay. You got $12,000 in another money market account at the bank. No, I think you're fine. I think you're in good shape.
Yeah, Fargo and 12 in a bank money market.
Yeah. No, I think you're fine.
Okay. Yeah. Well, look, while I'm talking to you,
okay.
Instead of raising the minimum wage, why can't our government just not tax anybody until they make $30,000? That gives everybody more take-home pay.
There you go, brother. That's a great plan. And what you just said is a plan that was laid out years ago. I can tell you when. It was 1998 because it was the first year I went on the radio. And I was interviewing Steve Forbes, who's always been a friend of mine and the ministry. And we were talking about that because he was running on this flat tax system. And his goal was, with his flat tax, was that anybody, well, back then, this was back in 1998, but back then it was anybody, I think it was like 21,000, which today would probably be somebody 30, 32,000. They would have an exemption. They would be exempt from paying any kind of tax, and everybody else would pay this flat tax. And when you worked out the numbers, it all worked out great. And it would just, I'm with you. I mean, I think it would be such a huge benefit to everybody else. And it's a great alternative to do that rather than raise the minimum wage. Good stuff. Thank you, Edward. I appreciate you weighing in, brother. Thank you. Let me go to Tamara from Oklahoma. Hey, Tamara.
Hey, how are you doing today?
Okay.
I have a question for you. I have 5 acres with a mobile home, like a double wide, and some horse pens and barn and stuff.
Uh-huh.
And my mobile home is really old. I've remodeled it and stuff, but it's basically very old, and I'd like to replace it and with a different house.
Mm-hmm.
And I was wondering if it's feasible, if the interest rate is going to be going up, in the future here.
Yeah, good question. I don't think it's going, the mortgage interest rate, of course, you're talking about, I don't think the mortgage interest rate is going to go up dramatically. Do I think it's going to go up a bit? I do. I think it could go up as high as a half a point, maybe even 3/4 of a point before the end of the year. But I don't think we're going to see a dramatic uptick. But the problem with that, Tamara, is it could change in a heartbeat. I mean, because of so much uncertainty from a political standpoint and economic standpoint, that we could see things change dramatically. I don't know if you've heard the whole program, but I think it was in the first hour. I had a fellow that calls in who's a rancher and farmer from Texas, was talking about the price of beef or the price of grain. And we continue to see this food inflation that's dramatic. And, the farmers aren't making anything, but, the stores are, we continue to see this food inflation. At some point in time, when I've been saying for the last 2 months, we think I read these numbers, one of the reasons I read them is so that I can remind everybody, and it helps me remember it. But, I've been talking for the last 2 months of cattle prices going up. I mean, it's almost every day I say, some commodities are down. Cattle, though, still up. Cattle continues to go up. Hogs are going up. The cost to feed cattle and hogs is going up, is one of the reasons why they're going up. Just one of the reasons. They have other issues too. But one of the reasons they're going up is we're going to see inflation. As inflation comes in, the Fed's got to cool down inflation. The only way Fed can cool down inflation is to raise interest rates. When the Fed raises interest rates, it's going to mean an interest rate hike on the mortgage rates. So I wouldn't panic and go out and try to buy a home right now because you want to lock in this very good interest rate, I don't know that I would panic, but I sure think you ought to try to set your mind on a goal, if it's at all possible, to get it done by the end of this year. Now,
okay, that's what I was wondering.
Yeah.
We don't really owe anything. We're pretty much almost.
Oh, that's great.
Well, probably $31,000. That's total debt. That's credit cards, house, everything.
Right. Well, let me just say this to you, Tamara, because this is really important. As you do this, because you're obviously interest rate sensitive, and you kind of get, you want to try to get a good interest rate and all those things. Please don't be lured into doing a variable rate mortgage. And I can save you a whole lot of anguish as you're being presented with all these scenarios as to why it is beneficial to you to get this variable rate mortgage rate, and it's going to look on the surface is very good to you. Don't even consider it. Just trust me on that. Just whatever you do, lock in your interest rate, your mortgage rate. Don't do anything variable. It is going to be a disastrous situation 5 years from now. So just lock in the interest rate that you get offered to you.
Okay.
All right. So
all right. Well, I
keep that in
appreciate
mind. All right, Tamara, thank you for your call. I sure appreciate it. Let me go to David. David calling us from Indiana. Hey, David.
Hey, how are you doing?
Good.
Yeah, I have a question. You talk a lot about energy stocks, and what's your thought on coal stocks?
Coal stocks. Well, I think the coal industry, I don't think the coal industry is dead. I think it's severely wounded in critical condition. But I think there's going to be somewhat of a revival in coal industry because of India and China and other parts of the world. I think that we will be, United States of America, will be a net exporter of coal. And mining will pick up again as that happens. The EPA has shut the coal industry down. I don't think they're finished yet. They continue to hurt the coal industry. Every senator and congressman that comes from a coal mining state like Indiana, Pennsylvania, Kentucky, Illinois, West Virginia ought to be ashamed of themselves. But and how they would ever get reelected is beyond me. But nevertheless, the only way I would buy a coal stock now, because they're cheap, the only way I would buy coal stock right now is if it's a very large company and you've got 20 years to wait. I mean, I think that and I'm not saying they're not going to come up for 20 years. What I'm saying is the process of becoming net exporters is going to take some time, a couple years from now. It's probably going to take a new administration before the whole mining process really would be able to kick up in full gear again. And, it's going to be a very slow process. So I would not be a buyer of coal. I would not be a buyer of any mining stock, whether it's mining for iron ore, coal, whatever it is right now. So that's kind of my take on it.
And then I have a second question. I bought some Westmoreland stock about maybe a month and a half ago, and it's jumped about 90%. Should I dump it then? Let me just take the gain on it.
Yeah, I probably would. I'd probably dump it. I mean, you're 90% up. Yeah, I would do it. Yeah, based on the kind of company it is. I think it would be. I think you've done really, really well. I would take the 90 and I would move it into a more stable energy environment. I would take all of it, move it over into maybe a refinery company, a big solid one like Phillips 66, or an oil company like ConocoPhillips or Marathon or Apache or one of those. All right.
Yeah,
Thanks.
Sounds good. I hope to see you May 15th.
Oh, good. You're great. That'd be great. I'd love to see you. And we're thank you, David. David was talking about Lafayette, Indiana, folks. If you live anywhere near there, May 15th, we're doing a town hall meeting in Lafayette, Indiana, and I sure hope you'll come out and greet us. I sure would appreciate meeting as many of you as I can. Let me go to Miller. Miller calling us from Louisiana. Hey, Miller. Let me go to Tyrell. Tyrell's calling us from Texas. Hey, Tyrell.
Hey, Dan, how are you today?
I'm doing okay.
Thank you, sir. Honored to speak with you. My situation, I've been with the company for about 10 years. I'm 43 years old, and I'm about to transition to CEO, a nonprofit that my wife and I started.
Uh-huh.
And so I've got a 401k with maybe $210,000 in it, savings of about 40, no debt, and some other ancillary investment accounts of maybe $10,000 or $12,000 in it. Just curious what your thought was to do with that 401k and how to best transition. And then an added wrinkle is the company I work for is just recently they announced an intent to be acquired by another company, and so I have restricted stock and stock options that are going to vest immediately, probably around June. And that should be maybe another 80 or 90 grand when those stocks vest.
Okay.
And so when I leave the company, I'll probably go ahead and sell those out and try to do something with that cash too. So just curious.
Yeah, well,
what your advice would be.
Yeah, I would say obviously your 401k money, I would roll that over into a brokerage IRA account. I would do that for sure on that. I would take a position. Do you think that once you do that you would continue to contribute to your IRA?
I would hope so. I'm going to take a significant pay cut, but my wife works from home. She's a writer and does quite well.
Mm-hmm.
So she contributes maybe $60 a year to the salary.
Okay. So yeah, I would roll that over into a brokerage account, IRA, something that you can have some control over and you can watch grow. And I would just be very careful. I would buy some individual stocks. I would try to build a portfolio of maybe 12 really well diversified stocks. I would maintain a cash position for the next year or two, depending on when we see the bottom in the market happen again. But I would probably have, because you're so young, I would probably say only 20%. Eventually, I'd like to see you have no cash. But for now, about a 20% position in the money market account of that IRA. And then I would just have some great individual stocks, some companies that are biblically responsible, some companies that have great growth potential, and some stocks that you're going to be continuing to contribute to on as regular a basis as possible. So that's going to be the key to the success of that account. So I think that ought to be your plan for your stock options when they come due and you cash out of those. Of course, you're going to have some tax to pay. Once that is done, I would make sure, because you're in a startup, nonprofit, I would make sure you have a good, solid emergency savings account. You may already have that. And then if you do already have that, or you have, one that you're just going to add to, then the rest of that money, I would open a same kind of account as your IRA and only an investment account. And I wouldn't do the same things. I would do something very different. If you want to take that stock money and do something like forget about it for the next 20 years, then I would take that money and I would dump it into a Timothy growth fund at Timothy Plan, mutual fund, and just literally forget about it. Put it in there and just, be done with it. So that's probably how I'd go.
Yeah, I've got about 40,000 in reserves right now. I mean, how much do you think?
No, you're probably. No, I think you're probably okay. Since your wife has a job that sounds pretty consistent, I think you're probably okay with that since you don't have any debt. So I would just leave it at that, and I think you'll be fine. Thank you, Tyrell. I appreciate you weighing in. I'm right up the end of the show here, but thank you for that call. I hope it helps you out. I want to thank Devin Patrick, Emily Halder for the work they do, and I think Jim Stanley and Jonathan Croker sitting in on the phones. I appreciate their work. It takes two people to do what Ann does, but two men to do what Ann does, I'll add. But anyway, I sure appreciate them filling in as well. I want to thank all of you for being with us. Remember, folks, all that we have is His. It's all the Lord's. Let's stand before Him someday and be found a good and faithful steward. Have a great day and a great weekend. God bless.
If we ever forget that we're one nation under God, then we will be a nation going under.